This is the second of 3 videos on orders. I keep making the point that stop orders are better for most traders when you enter trades. Skilled traders will also use market and limit orders to enter trades. If a trading range is pretty tight, it's a limit order market, and most traders should not trade when the range is tight. They should instead look to trade when the market has reasonably good swings or trends. Most traders should enter every trade using a stop order, because for a stop order to get filled, the market has to be going in your direction, and that slightly increases the chances that you'll make money. For example, we have a swing up here and then a pullback and a bull reversal bar. To buy using a stop, you place your stop order just above the high of this bar. If it's a Forex market, you place the order 1 pip above. If it's a stock or a futures contract, you place the order to buy 1 tick above the high of that bar. You're buying on a stop. This bar is the signal bar. If this bar goes above the high of that bar, which it did, it becomes the entry bar. As soon as the market goes 1 tick above the high of the signal bar, your stop order is touched, and that makes it a market order, and you get filled, usually at the stop order price, sometimes a little bit worse. Rarely better. Sometimes it'll hit the stop and it instantly goes down. That's very rare. Usually you're going to get filled at the stop order price. Maybe 5% of the time, 10% of the time, you get filled a little bit worse. I talked earlier about bracket orders, and you should always have a bracket order whenever you enter a trade. As soon as your order to enter gets filled, your broker's software should allow you to program both a protective stop and a profit-taking limit order, which I do not show here. At a minimum, though, whenever you enter any trade, you should immediately place a protective stop somewhere that makes sense. For example, below the bottom of a signal bar or below the bottom of a bull trend. Most traders should always be going for a reward that's equal to at least twice their risk. If their initial risk is here, a reasonable target is 2 times the initial risk. So traders will exit with a limit order at that price. And you can see what happened when the market reached 2 times the risk. You buy here, your initial risk is here, 1 times risk, 2 times risk. You can see there was selling. Most of that selling is from bulls taking profits. Some of it is from bears who expect the bulls to take profits, and they're shorting for a scalp. In the video on risk, I talk about initial risk versus actual risk, and I'm using initial risk here. You're initially risking here. If you get filled here above this bar, the market might have pulled back here and went up. Your actual risk was only to just below the low of that bar, and it's less. However, it's always reasonable to try to go for a reward equal to 2 times your initial risk. Again, beginners should only be entering with stops. They want to be swept into the trade by the market going their way. That makes it easier emotionally. Even if the market's only going your way 1 tick or 1 pip, psychologically it's easier to manage the trade if the market is going your way. Anytime you're entering with a stop, you're entering on the breakout of the prior bar, betting on a profitable breakout. For example, if you're buying with a stop here, you're buying a breakout above the high of that bar. If you're buying above this bar, you're getting filled once the market breaks above the high of that bar. If you're selling with a stop, for example, below the low of this bar, you get filled when the market breaks below the low of the bar. You're entering in the direction of a breakout. A limit order trader is doing the opposite. I'll talk about that later. Stop orders, they're good during trends. The market's going up. If you buy above a bar, the market has to go up for you to be filled. That's the direction the market is heading, and there's a higher probability that you'll make a profit. When the market starts to go sideways, stop orders are bad. Selling below this bar, buying above this bar, buying above that bar, selling below that bar. In a very tight range like this, it's a limit order market. Beginners should only be trading with stop orders, and that's the exact wrong way to trade a market in a tight trading range. And therefore, beginners should not trade when the market looks like this. This is a limit order market. Traders buy below bars looking for scalps. They sell above bars looking for scalps. They buy below prior lows looking for scalps. And that is beyond what a beginner should be doing. Again, entering with stops above this bar, above that bar, selling below that bar, buying above this bar. Stop orders are going to lose too often. When the range is tight like this, you should not be trading at all, and you certainly should not be trading with stop orders. Experienced traders enter at the market, and they'll also enter with limit orders. And both of those are, I think, beyond what a beginner should be doing. He'll make too many mistakes and he'll lose money. If the context is good for a swing up, and a bull sees a bull bar closing on its high, a good-sized body, and then a second one, bulls will start buying closes here or here. As soon as the bar closes, they hit buy the close, and they get filled at that price. They might get filled on this bar just as it closes if they enter right before the close. If they enter at the close, they'll get filled on the open of the next bar. That's a high probability bet that the market is going at least a little bit higher. After a beginner has some experience with stop orders, he can start experimenting with some market orders. Buy the close markets, strong bull trends, buying closes, or in a strong bear trend, selling closes. Experienced traders will also enter at the market. If they feel like the market is racing up with a lot of momentum and is likely to go higher, instead of waiting for a pullback, the trader might simply hit the button to buy the market. For example, if the market's going up and he hits buy the market, it might get filled here a little bit above the instant when he hit the market order, betting that the market would go up at least a little bit higher after this much momentum. Experienced traders will also enter with limit orders, betting that reversals will fail, for example. Very strong bull trend, very tight bull trend, a lot of bull bars closing on their highs. A weak sell signal bar. Do you think there'll be more bears selling with stops below that bar, or more bulls buying with limit orders at the low of that bar? An experienced bull will place an order to buy at the low of that bar. He'll get filled here. He'll put a stop maybe below the bottom of this breakout, probably below the bottom of this bull trend. The market's going against him. It's falling and has a strong bear bar, but he's confident in his position. He'll hold long. He might even add on lower. That is a type of trade that is very difficult for a beginner to do. If he buys at the low of this bar and he sees this big bear bar, at one point this was also a big bear bar. It ended up closing on its high, but at one point it was a second consecutive big bear bar, and a beginner would feel too much stress to manage the trade correctly. The bars are starting to get small. We have big up, big down, big up, big down. We're probably going sideways. Expert traders will start selling above bars. After 5 bars down, 4 of them bear bars, bulls will bet the first reversal up will form a lower high and there'll be a second leg down. Bears will bet that there'll be sellers above the high of this bull bar and a second leg sideways to down. They'll therefore sell with a limit order at the high of the prior bar and possibly add on higher looking for a scalp. They're betting that the breakout above the high of this bull bar will fail. There'll be sellers above and the market will trade down far enough for a scalp. In a tight trading range, limit order bears will sell above bars. Limit order bulls will buy below, betting that breakouts will fail. They'll also buy at the prior low. Again, this is more than what a beginner should be doing. A bull might place an order to buy at the prior low, this low or that low. He'll get filled here. Even though it's a bear bar closing on its low, the bull will bet that the trading range will continue and that any breakout down or up will fail, and therefore buying a bear breakout will lead to a profitable scalp. Every time you see a tail on the top of a bar or on the bottom of the bar, it's a failed breakout. If the market has a lot of bars with tails and a lot of overlapping bars, it has a lot of bars that are failing to break out above or below the prior bar. And therefore, instead of entering with stops betting on successful breakouts, you have a better chance to make money if you enter with limit orders betting the breakouts will fail. Again, this is something that only experienced traders should do. A market that has lots of reversals is bad for stop orders. If it's bad for stop orders, a limit order is basically the opposite side of a stop order. It's good for limit orders. Big tails on the tops of bars, the breakouts are failing, more sellers than buyers as the market's going up. Therefore, traders will sell breakouts betting that they'll fail. They'll either sell the high of the prior bar, for example here, sell the high of this bar, betting the breakout will fail, or they'll sell at the high of a prior high. For example, they'll place a limit order at this high, betting that the breakout above it will fail. Again, limit orders are bets that breakouts fail. Stop orders are orders betting that breakouts succeed. They're basically opposite of one another. Big tails below bars, the breakouts are starting to fail. Bulls see that, and they'll place limit orders to buy at prior lows and at the low of the prior bar. For example, they might buy at the low of this bar or at the low of that bar, or if the market falls below this low, they'll buy as well. They're betting breakouts will fail. Again, stop order traders are selling at that low, betting on a successful breakout. When the market's in a trading range and it has a lot of tails and a lot of reversals, that is a bad bet. More likely, there'll be buyers at that low, not sellers. And therefore, buying that low has a better chance of making money than selling on a stop just below that low. This is a limit order market, a trading range. Bad for stop orders, good for limit orders, because they are doing opposite things. The stop order trader is betting on a successful breakout. The limit order trader is taking the opposite side of that trade. He's betting that the breakout will fail and reverse. Whenever you look at a chart and you're not really clear of the direction, if there are a lot of dojis, a lot of tails, a lot of overlapping bars, a lot of little reversals, the probability is bad for stop order traders. Also, if the bars are big, then the risk is big. The stop is going to be far away. Your protective stop is going to be far away. For example, buying above the high of this bar, we have a lot of reversals. The probability is we'll get another reversal. The probability for a stop entry bull is small. The bar is big, so his risk is big. Therefore, you have a bad risk-reward ratio and a low probability. If you're going to take the trade, it makes more sense to do the opposite, to sell at the high of that bar instead of buying just above the high of that bar. Stop and limit orders are basically the opposite side of the same trade. Very big bull reversal bar, but lots of reversals. Big up, big down, big up again, probably trading range rather than bull trend. And therefore, buying at the high of anything is usually a losing strategy. It's a low probability bet. Experienced traders instead will place a limit order to sell that high, betting that instead of a bull trend, the market will go sideways and he'll make money selling above bars, betting that bull breakouts will fail and reverse far enough to make a scalp. Therefore, probably more sellers at this bar's high and above its high than there are buyers. It's a limit order market. Since 95% of all trades are traded by institutions, you should assume that for every trade, one institution is buying and another one is selling. You also have to assume that both are doing something that is rational. How can it be rational for one institution to buy and another institution to sell? Well, 90% of the bars on every chart are either in a channel or a trading range, and if you manage your trade correctly, scale in, you should be able to make money buying or selling at any given moment. One institution is buying above this bar, betting that the market's going to go higher, but that institution may also be willing to scale in lower. For example, right here, again entering on a stop, betting that this was a rational buy, therefore the market should get back to that price. He can get out break even at his first buy and with a profit on a second buy. Another institution will do the opposite. He'll sell this high, betting that the market will turn down and he'll be able to make a profit. Another institution will sell this high, betting that at worst it's a trading range. It could be a bear trend. And if it's a trading range and rallies, it'll come back down to that price. And if he sells more higher, he can make a profit. You can see the market got down to that price and the market went up. Part of the reason it went up is bears sold here. They sold more higher and they're buying back their shorts at their original entry price. Some bulls will buy below this bar, betting that we have consecutive bull bars. The reversal down will probably not get very far. Here you have a wedge, 3 pushes down, 1, 2, and 3. And you have dojis, tails on the bottom. Traders are buying lows. Some bulls will buy at the low of that bar, betting that it's a bad bear flag. It's a bear trend, but it's also probably a trading range at or around the bottom of the bull trend. And we keep getting reversals, bear bar, bull bar, sell off, rally, sell off, probably a rally. Therefore, bulls will buy at the low of that bar, betting that the bear breakout will fail and that we'll get a reversal up. Bears, they'll sell with a stop, betting on a bear breakout. Some will even sell down here, hoping that it's a bear channel that just continues down all day. They're confident that with a channel this tight, worst case is any rally will be minor and lead to a trading range rather than a bull trend. If they sell here and scale in higher, they can avoid a loss and usually make a profit. Remember, 10% of the bars on a chart are in a strong breakout, and you should only trade in the direction of the breakout. 90% of the time, there's always an equally valid trader's equation for the bulls and the bears if they manage their trades correctly. Again, during a strong breakout like this, it's better only to sell because the first leg down will probably be followed by a second leg down, and the first reversal up will probably be minor, either a bear flag or a bull leg in a trading range. In either case, the market should trade back down. What's better, a stop order or a limit order? Well, they're equally effective. At any given instant, the probability that the market is going up or down is just about the same. If you look at any chart, a limit order or a market order wins about as often as a stop order. Half the time, stop orders are better. Half the time, limit orders are better. The more the market's going sideways, the more often a limit order will make money. The more the market is trending, the more a stop order will make money. Here, a trader wins selling with a limit order at the high of that bar. And over here, we have a failed breakout above this high, a little bit of a parabolic wedge, 3 pushes up, 1, 2, 3, 2 small legs up, 1, 2. It's a reasonable short for a stop order trader, betting that the reversal down will be profitable. Beginners should only enter with stop orders. Rarely, with some experience, they can begin to enter with market orders or limit orders, but only in the direction of strong trends. Experienced traders, they use limit orders just as often as stop orders. Some traders have a preference for stop orders. Other traders prefer trading range scalps and they prefer limit orders. But in general, expert traders use both. A trading range is a limit order market. A trending market is a better market for stop orders. A trading range is a limit order market, especially if the range is tight, and it's better to buy low, it's better to sell high, it's better to take quick profits, betting that the leg is not going to last very long. You buy low, you sell high, you scalp. Can you buy here? We have a wedge bull flag, we have a breakout and a pullback. And here we have another bull breakout and a pullback. Can you buy above here? Sure. But if you're buying near the top of a trading range, the probability is you're going to get a reversal down. To make money, usually you need to have a stop below, and it's better to scale in lower. Buying at the top of a trading range, your stop is down here, so the risk is big, and the probability is not very high unless you're willing to scale in. Buying up here, your stop is below the bottom of the most recent major high or low. We have a good reversal up here and a slightly new high, and therefore this is a fairly significant high or low, a major high or low. If you're buying up here, then your stop is just below that low. Buying high means the risk is big, the stop is far below. And buying at the top of a trading range means that the probability of making money is low, unless you're willing to scale in lower and use wide stops. Big risk and low probability means bulls buying with stops at the top will lose money unless they manage their trade correctly. Instead, bears selling with limit orders, betting that bull flags at the top of the trading range will fail, have a much better chance of making money. Experienced traders would rather be selling above bull flags at the top of a trading range, in other words, entering with limit orders at the high of the prior bar or at this high, at the high of this bar or at this high, betting that the breakouts will fail and lead to another leg down in the trading range and test near the bottom of the range. Trading range, a limit order market. It's better to enter with limit orders, selling near the top, buying near the bottom. But again, you only do that once you're an experienced trader. If a bear sells with a stop near the bottom of a range there, here, or here, his stop is far away. That means his risk is big. An experienced trader can make money selling low in a trading range, but only if he's using the appropriate stop and scaling in and exiting appropriately. The stop for a bear selling here, it might be at the top of this final leg down. It might be at the top of the trading range. In any case, selling here, the stop is wide, the risk is big. Selling below this small bear flag, stop up here, big risk. Strong sell-off, we have a small bear flag, selling at the low of that sell signal bar, the risk is very big. Since most trading range breakout attempts fail, selling at the bottom of the range is betting on a successful bear breakout of the range. It's probably going to fail. That means the probability of making money selling near the bottom is low. You have big risk selling at the bottom of a range. The stop is far away, and the probability is low. And therefore, selling with stops at the bottom of the range, it's difficult to make money unless you use the appropriate stop and scale in higher, and that's something most traders cannot do. However, bulls know that. They know the risk for the bears is big. They know the probability for selling at the bottom is bad, and therefore bulls will buy with limit orders below bear flags, betting that the bear breakout will fail, reverse up, and go up high enough for the bulls to make money. They'll buy at the low of that bar, get filled here, and make a profit on the rally. They'll place a limit order to buy at the low of this sell signal bar or at that low, betting that the bear breakout will fail and they can make money on a buy scalp. They'll buy at the low of this bar, betting the bear breakout will fail. They'll buy at the low of the leg down, betting on a reversal instead of a breakout. Buying with limit orders will make money. Selling with stop orders at the bottom of a range will lose money. If the range is tight, most traders should not trade. Whenever a trend is strong like this, it does not matter what type of order that you use. All that matters is that you trade in the direction of the trend. Here it's a strong bear trend, so you should only sell. And you can sell with stop orders below bars, you can sell with limit orders above or below bars, you can sell with market orders, you can sell at any time. When the market's in a strong trend, only two things matter. You can only trade in the direction of the trend, here sell, and the other thing is you have to get into the trend. You have to sell, and you can do it with any kind of an order, stop order, market order, or limit order. When a channel down is very tight, the pullbacks are small, they only last a bar or two, some traders will sell at the market. Also, they're starting to get strong bear closes, traders will sell the close. As soon as the bar closes, they hit sell the market, or right before it closes, they hit sell the market. Sometimes as soon as it closes, they place a limit order to sell at the close of the bar, hoping to get filled on the next bar. However, sometimes the next bar does not go above the close of the prior bar and your limit order does not get filled. It's usually better just to sell the market when you think it's a sell the close bear trend. Anytime the market is trying to reverse, bears will sell with limit orders at the high of the prior bar, betting that the reversal will fail and become a bear flag, and the bear trend will resume. The bull's trying to get a reversal? Well, most reversals fail, and the first reversal is usually minor. Bears will sell the close of a strong bull bar, betting that the reversal up will fail and the bear trend will resume. Bears will also enter with stops below every reversal attempt, thinking that the reversal attempt will be a bear flag and that the market will continue down. They'll place a stop order to sell just below the low of the prior bar. When traders start out, they should only enter with stop orders. In fact, most traders should enter with stop orders throughout their trading careers. Skilled traders often use market orders and limit orders as well. When the market's in a very tight trading range, it's a limit order market, and most traders should not trade at all. When the market's in a strong trend, traders should enter with any kind of an order, a stop order, a market order, or a limit order in the direction of the trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on orders.